takes us to our talk of the tape. What the final 2 months of the trading year will hold for investors. Let's ask our panel. CNBC contributor, Trivariate's Adam Parker, NewEdge Wealth's Cameron Dawson, and Invesco's Brian Levitt. One and all, it's good to have everybody here. Cameron, you first. We seem to be set up pretty well for the final 2 months. Is that how you see it?
Well, I think when we put together seasonality, which we know is typically very good in November and December, you add in the fact that there still is signs of positioning just being neutral, meaning institutional investors are definitely not absolute overweight at this point. And now you have this earnings lift where earnings estimates continue to get revised higher, which just means that it's a good backdrop for risk taking. So you're seeing cyclicals outperform defensives. You're still seeing high beta names outperform low beta names. So all of this suggests that there's a continued drift and chase higher.
What do you make of some of the talk about these divergences within the market? Brian, Jonathan Krinsky at BTIG has a note. Brian, I'll go to you on this. November could be a down month, he says. The S&P 500 hit an all-time high. This is last week. Yet 33% of its components are down 20% or more from their 52-week high, and 24% are within 10% of a 52-week low. We're all hyped up on where the hype is. But everything else doesn't look that great.
Everything doesn't look that great. We have to remember that we've been in a soft patch for economic activity. We knew things were going to slow as we moved into this, through the summer, into the back half of the year. That was what a lot of the concerns over tariffs and a Federal Reserve that didn't want to ease. So you have not had a robust growth environment, and in a pretty benign, in a modest growth environment, investors tend to look for companies that can generate growth. So what the hope is as you move into 2026, some policy support from the Fed, some policy support from the One Big Beautiful Bill Act. Perhaps you start to see leading indicators pick up again, and there are valuations that are more attractive outside of the big names.
Does it matter at all what I just talked about, what Jonathan Krinsky cites? Remember that was that day last week or the week before where you had like the worst breadth day on an up day in like forever. You had, the stocks we keep talking about, all AI all the time, looking great, and then a lot of other stuff under the surface doesn't look so good. Does it matter or not? Maybe it doesn't. I'm not asking. I'm not suggesting by asking the question like in a leading way, expecting you to say, yeah, it matters. Maybe it doesn't matter.
Well, I didn't. A couple months ago, you asked me a Krinsky question. I didn't know who he was, and I said I didn't know who he was. Then I got crap about it, and then I connected with him. So now I do know who he was.
All right, good.
So I don't want the first thing I say after I know him to be critical of what he said. All I'll say is I'm not sure that I can predict subsequent 1 month market return with breadth indicators, consistently. I think what's going on is the big 8 companies, Broadcom plus the Mag 7, are 42% of the S&P market cap and 55% beta adjusted. So of course that it's an AI market, because these stocks are massive and their volatility around earnings is massive. It's very hard to predict quarter to quarter. Think about Q1. The narrative was Meta's awesome and Google's missing it. Now Google's awesome and Meta's so for you to consistently get in out of these, that's why we've been mostly saying let's keep around market weight and make big active bets elsewhere. I think the important thing about what Krinsky's saying, the number of companies that are lagging by 20% or more is really high versus history. So if you're a good short seller, or if you're someone who kind of has a long-only approach, you can really avoid the blow-ups, I think, better than normal. I think it's a better than normal stock-picking environment right now.
You had made the point, Cameron, that low quality has been leading. Does that matter?
It does matter because it's a reflection of risk appetite, but it also matters because it tends to not last forever. Low quality is a here for a good time, not for a long time type of trade. And we learned that in 2020, 2021, and then these reversed completely in 2022. And so this market coming off the April lows has been absolutely defined by speculative, low quality, very high beta. Companies in the NASDAQ composite with no revenue, not just no earnings, but no revenue, are up 57% this year on average. That's a function of clearly we're swimming in liquidity, but we also have to realize that when this reverses, eventually, because it always does, when this reverses, there will be significant downside in those areas.
But only in those areas. I mean, if you want to talk about like similarities and differences between 99 and that period in the run-up and the creation of the bubble and then the blow-up, that's an area that maybe you could point to. What Cameron just said, all these companies, they don't even have any revenue, and they're up that much. like when do you have to pay the piper and show some revenue before you see those declines potentially hit the market?
I mean, I agree with Cameron that at some point you will see it happen, and it'll happen with somebody stubbing their toe in this, or it becoming clear that artificial intelligence perhaps doesn't provide the capabilities that many expect it to. That's not my forecast, but at some point you'll have a trip up in here, and then the AI trade will extend once you have some type of correction.